Welcome to This Explainer, where we're diving headfirst into the wildly complex and frankly kind of crazy world of U.S. health insurance. Did you know that an estimated 80% of medical bills actually contain errors? 80%. So today, we're decoding exactly how a medical payout works. Because let's be honest, understanding health insurance isn't just about knowing your monthly premium. It's really about mastering the mechanics of who pays what exactly when you actually need healthcare. To really wrap our heads around this, picture this scenario. You go to the hospital for a procedure. You've got decent insurance, so you naturally assume your coverage is going to handle the heavy lifting, right? Well, a few weeks later, you check your mailbox, open an envelope from the hospital, and your stomach just drops. You're hit with a massive panic-inducing $20,000 sticker shock. But at first you might think, okay, great, my insurance is going to pay that $20,000. But then you actually read the document, you crunch the numbers, and instead of a zero balance, you see that you suddenly owe $4,000. It leaves you totally bewildered, asking, wait, what just happened? Why didn't my insurance pay the whole bill? Well, to demystify this exact scenario, we're going to follow a fictional patient. Let's call him John. We'll trace the exact journey of his $20,000 surgery from the moment he leaves the in-network hospital all the way to his final payment, just to see exactly how that massive number gets sliced and diced. Section 1, the confusing medical bill. Okay, so the very first thing that happens behind the scenes is that the insurer completely ignores that terrifying $20,000 list price. Literally, they ignore it. Hospitals use what are known in the industry as charge masters. These are highly inflated, somewhat arbitrary list prices that basically just serve as starting points for negotiations. Instead of paying that inflated price, the insurance company uses what's called the allowed amount. Because John stayed in network, the hospital and the insurer have a pre-existing contract that establishes a strictly negotiated rate for this specific surgery. So, for John's care, that $20,000 charge is immediately slashed down to $12,000. Boom. That $12,000 becomes the new absolute baseline for everything that follows. Now, we've got to figure out how that remaining $12,000 cost is actually split between John and his insurance company, because standard health insurance is rarely designed to pay 100% from the very first dollar. Cost sharing is an absolutely foundational piece of the puzzle here. Section 2, sharing costs and deductibles. This brings us to the deductible. Think of the deductible as the healthcare equivalent of a cover charge just to get into a club. It's the amount you literally have to pay out of your own pocket before your plan even starts contributing. If John has a $2,000 annual deductible that he hasn't met yet this year, he has to pay that cover charge first. So we take that $12,000 allowed amount, subtract John's $2,000 deductible payment, and we're left with $10,000. Only now, after that cover charge is paid, does the insurance plan begin applying its cost-sharing percentages. Now, when it comes to splitting that remaining bill, you're generally going to encounter two primary cost-sharing methods. First, you have a copay. This is simply a fixed, predictable dollar amount, like a flat $30 charge for a primary care doctor's visit, or maybe $20 for a generic prescription. Pretty straightforward, right? On the other hand, you have coinsurance, which is a percentage of the remaining bill that you are responsible for paying. Coinsurance scales with the overall cost of the procedure, which, you guessed it, is exactly where things can get incredibly expensive. In John's case, his plan uses 20% coinsurance. So of that remaining $10,000 balance we just calculated, he is on the hook for 20%. That comes out to $2,000. The insurance company takes the much larger 80% slice, which means they're paying $8,000. Section 3, reading your EOB. Eventually, you'll receive your explanation of benefits, or EOB for short. And this is where you'll see the complete culmination of all this math. Let me be crystal clear. The EOB is not a bill. It's your ultimate receipt and decoder ring. You can trace the entire life cycle right there in the breakdown. The original $20,000 charge, the $12,000 allowed amount, his $2,000 deductible, his $2,000 coinsurance, the $8,000 the insurance paid, and finally, his total patient responsibility of $4,000. In fact, the Centers for Medicare and Medicaid Services highly recommends comparing the actual medical bill you eventually get from the hospital with the specific EOB document. You want to make absolutely sure the services and amounts match perfectly. But wait, what happens if John hadn't gone to an in-network hospital? Well, if you go out of network, you might face something called balance billing. This is where the provider bills you for the massive difference between their inflated list charge and what your insurance actually decides is allowed. Yikes. However, there are modern protections you absolutely should know about. The Federal No Surprises Act protects you in many emergency situations. It also covers really common surprise scenarios, like say you go to an in-network hospital for surgery, but the anesthesiologist who happens to be working that day is out of network. In the past, that anesthesiologist could hit you with a massive surprise bill. Now, federal law limits those unexpected out-of-network charges in many cases. So don't just assume an out-of-network charge means you're legally obligated to pay every single cent. Anyway, as those deductibles and coinsurance payments add up over the course of the year, we finally arrive at the patient's ultimate financial safeguard. Section 4. The Out-of-Pocket Maximum. The out-of-pocket maximum is exactly what it sounds like. And honestly, for patients with chronic conditions or folks facing catastrophic medical emergencies, this is a massive source of financial relief. Once your eligible spending hits this specific annual cap, your insurance plan steps up and pays 100% of your covered in-network healthcare costs for the rest of that plan year. It literally puts a hard ceiling on your financial risk. But, and this is a big but, you absolutely have to read the fine print. Crucially, certain financial obligations do not count toward this limit. Things like your monthly premiums, services the plan simply doesn't cover, like, say, cosmetic surgery, and certain out-of-network expenses. It is an annual cap exclusively for eligible covered services. It's not a magic, all-encompassing shield against every possible healthcare expense you might invent. But here is where the math really works in your favor for once. Let's say you have a major surgery where your deductible and your coinsurance math technically totals $6,600, but your annual out-of-pocket max is exactly $6,000. Your payment hard stops at exactly $6,000. You don't owe that extra $600. The insurance company absorbs it entirely. And from that moment on, they generally cover 100% of your remaining eligible in-network costs for the rest of the calendar year. It's a real game changer for your wallet. Okay. Now that we've peeled back the layers of math and seen how cost sharing actually works in practice, let's pull all these pieces together. Section 5. The Complete Claim Journey. First, a crucial warning. If you open your EOB and it says denied instead of paid, take a deep breath. Seriously, do not panic. A denial doesn't automatically mean you have to pay the entire bill out of pocket. It might just be a missing authorization, a simple coding error from the doctor's office, or the insurer might just need a little more info to process it. Studies show that a massive percentage of denied claims are actually completely valid but are never appealed by patients, leaving millions of dollars on the table simply because people get overwhelmed and give up. If you believe the decision is wrong, you absolutely have the right to appeal it. Just keep your bills and supporting paperwork meticulously organized. Ultimately, the entire life cycle flows like a step-by-step process. First, you receive care. Second, the provider bills the insurer directly. Third, the insurer calculates the allowed amount and your cost sharing, based entirely on your specific plan's deductibles and coinsurance rates. Then, they pay their portion to the hospital. And finally, you receive your EOB, match it against your actual hospital bill, and pay your remaining share directly to the provider. Remember, the insurance company rarely sends the money to you directly. They deal with the hospital, and you deal with whatever is left over. Understanding exactly who pays what and when can literally save you thousands of dollars in unexpected costs and unnecessary stress. It's all about knowing your network, actively tracking your deductible, and understanding the protection of your out-of-pocket maximum. So, the next time a terrifying medical bill arrives in your mailbox, what's your move? Will you just blindly write that check, or will you decode your EOB first? Thanks for joining us for this explainer, and we'll catch you next time.